Hi there. Welcome to The Open on BNN Bloomberg. I'm Lindsay Biscaya in for Andrew Bell today, who is down at the PDAC Mining Conference, and we will be reporting throughout the day with Andy Bell down there. But first of all, let's get to some of the other stories we're following for you in the BNN Bloomberg newsroom. Prime Minister Mark Carney has landed in Australia after wrapping up his trade trip to India. Carney is expected to meet business leaders in Sydney as Canada seeks to build on already strong intelligence ties by broadening collaboration in defence, security and trade. Carney will also meet with Australian Prime Minister Anthony Albanese and will address the Australian Parliament in Canberra before leaving for Tokyo. Shares of Pinterest are trading higher in the pre-market this morning. Activist investor Elliott Management is investing $1 billion in the social media company to help fund its year-long effort to buy back shares. The latest share repurchase will be carried out as part of a new $3.5 billion U.S. program authorized by Pinterest's board. The American company also plans to buy as much as $500 million in additional shares from cash on hand. And shares of Best Buy are climbing in the pre-market. The electronics store chain topped earnings estimates on sales for certain products. The American company saw continued strength in computing and mobile phones. New categories like AI glasses, 3D printers, health rings, and gaming handhelds also saw strong growth. Best Buy has raised its quarterly dividend by 1%. Take a quick look at the markets here. The U.S. futures all trading down this morning. The Nasdaq down by more than 2% at the moment. Obviously, investors still cautious, watching what is unfolding in the Middle East. Similar story for the TSX, obviously, before the bells open. This is where the TSX closed yesterday, and we'll continue to watch that today. We're also watching the price of oil, which has been surging over the last couple of days because of this conflict in the Middle East, currently up by more than 7% to start the day. Stock futures are under pressure and oil prices are pushing higher because of the conflict in the Middle East. U.S. Treasury yields are also higher on concerns that higher energy prices could boost inflation in the U.S. So let's get perspective from Sadiq Adatia, Chief Investment Officer at BMO Asset Management. Good morning. It's good to have you join us.
Thank you for having me.
These concerns of lengthy disruptions in the energy market and a surge in inflation, do you think those are valid concerns?
I don't think you're going to see long-lasting inflation, but temporary inflation is definitely possible. I think what we're seeing today with oil spikes is something we've seen time and time again, where we do get escalated oil prices that last for anywhere between a few weeks to a few months, but then eventually come back to the demand and supply fundamentals. And I think that's what you're going to end up seeing here. This might last a little bit longer given the tensions. But I do think this is an opportunity where if you've enjoyed the ride up on the energy side, would not be a bad time to start looking at taking profits as well.
Okay, taking profits. Is there any other ways that you think investors could maybe take opportunities through this volatility?
Yeah, there's two things. One, there's a lot of things that will get hit as a result of this, many of which have nothing to do with oil or potentially, what is going to go on in the Middle East. So I think there'll be some opportunities here for some of the potentially higher risk names that have got hit quite hard to potentially look at these as entry points to get back into them. So I do think that sometimes when we look at situations like this, we get a little bit scared and nervous. And I understand that for sure. But it also creates opportunities in this environment when people get overly nervous about the markets. And I think this is an opportunity that we'll see play out over the next couple of weeks.
Okay, so let's move on then. We'll talk about a couple other things that have been affecting the markets of late, and that is tech stocks. You believe there is a shift away from the hyperscalers. Is that right? What do you think is happening in the tech sector?
Yeah, I think, unfortunately, I still believe in the AI story and what is going on there. But unfortunately, we're seeing a lot of sentiment that's driving away from the AI space. And that does put pressure on valuations, on stock prices. It's hard to beat on the earnings story. NVIDIA is a good example of that. It was a good story, but still saw the stock drop. I think so. It's opportunity time to continue to diversify a little bit away from just the tech names and to a more broader sector story, but also a more broader geographic story as well. And that combined should give people still a good outcome at the end of the year, a little bit less risk, but it also does reduce a bit of the upside as well, because I do think longer term, the AI story still continues to be much stronger. But in the short term, I think what you see benefits out of is not those who are at the forefront of the AI story, but those that are going to be potentially implementing the AI story within their companies and helping drive margins higher.
Okay, so you mentioned a shift geographically. So I wanted to get into that a little bit more because you think there's, we're starting to see a rotation away from the US. You like some of the emerging markets. What specific emerging markets do you like?
Yeah, there's actually a few emerging markets I really like. I mean, obviously Brazil, Taiwan, South Korea are all going to do quite well, and they've already started to do quite well. But I think the laggards of the last 2 years, India and China, should actually bounce back. Now, obviously, the recent events are not going to be good for India, given they're a net importer of oil. But if you think out longer term, I think both these countries have the right fundamental approach going forward. Population is there, middle class is growing. We're seeing trade deals being formed with them that I think are going to be beneficial longer term. So I think these are areas that continue to see opportunities, but are underinvested at the moment. And so a catalyst can really easily push them much higher from where we're at today. And we are seeing the sentiment move away from the U.S., albeit slowly, but it is moving away. And if you go back, maybe 5 years ago, there's still room for it to come down to be at those levels that U.S. allocations were at 5 years ago. And still have a higher allocation to the U.S. Over the long term. But in the short term, I think it's time to rotate a little bit away and find areas like emerging markets.
What about Canada? Are there opportunities still in Canada, or is that kind of included in the rotating away from the U.S.?
Yeah, I think the Canada story here is kind of be a defensive hedge story. If you think about what's make up in the TSX as example, the precious metals and energy both obviously have done quite well more recently in the turmoil that's going on. And I think that's how you got to look at Canada right now, is if the market is going to be, on a risk-off mode, if you're worried about the AI story, if you're worried about, valuation being too high, then, Canada provides you a bit of that comfort because it is not high valuations. It has things that are more defensive in nature. So that's how I would look at it. But if you're looking at it just purely from a growth perspective, Canada does lag behind because it does not have the growth the U.S. has. Consumers are not as strong as the U.S. in particular. And then we do still have this USMCA deal that is going to put, a bit of a cloud over growth in Canada as companies, decide how they want to proceed and likely sit on the sidelines, both on growing their business and actually adding employees until they get some certainty around the USMCA deal.
It's pretty daunting, but I do take your point. There's just so much uncertainty right now for Canadian businesses and for Canadians. Okay, so we covered the geographical shift, but you also mentioned, going back to our conversation about tech stocks and shifting a little bit away from those big hyperscalers. What other sectors do you like right now?
Yeah, I mean, we still like the financials. I know they got hurt in the last, again, a week or so, but yield is an important story, I think, in this year as well, because I don't think we're going to see returns that we've seen over the last few years. And so financials tend to have a pretty good, healthy dividend yield. I think there's still a lot of upside there as well. And that's not only just in Canada, US, but also internationally as well, and emerging markets. So I think there's an area there that you could see some potential upside. We've been obviously bullish on gold for quite a bit of time since 2023, owning it each year for kind of a different reason. But I think you still want to own that for upside, but also for that geopolitical risk hedge. And I think if you look through, we're starting to see consumer staples looking a little bit more attractive as well. I know valuations are a little bit higher there from that standpoint. And then even within the tech space, I think you want to be rotating around some other areas within tech. So maybe not the front line order of the AI story, but down a couple of spectrums down, where I think you might see some better opportunities, lower valuations. And I think that's where you want to look at on a sector perspective as well. But overall, I do think that, again, it's just a matter of rotate a little bit less, away from the U.S., a little bit more away from the U.S., and start adding to the other sectors like financials in particular. Okay,
Sadiq Adatia, Chief Investment Officer at BMO Asset Management. Appreciate your time, sir. Thanks so much for joining us.
Thanks for having me.
Coming up, we are continuing to follow fast-moving developments as the U.S.-Israel-Iran conflict enters its fourth day. Explosions, missile strikes, and widening regional retaliation are reshaping the situation by the hour. More on that coming up right after the break. Escalating geopolitical tensions have pushed the price of oil and gas higher as global supply routes are threatened. CTV's Mike Licouteur has more in this report.
Trips to the gas station were a little more expensive than some drivers had expected today.
I mean, gas is, expensive as it is, and then with this war affecting it, I mean, who knows where it'll go.
As a student, this is, it's barely affordable.
Yeah.
It's hard to get to school.
While oil and gas analysts say the current price at the pumps doesn't reflect any damage to refining facilities in Saudi Arabia or the United Arab Emirates, they are bracing.
This is potentially the biggest shock for the oil market since 1990 when Iraq invaded Kuwait.
One of the reasons is the Strait of Hormuz. The narrow waterway south of Iran is one of the most important maritime routes in the world, as about 20 to 30% of global oil and gas passes through the strait. The federal energy minister believes the conflict means countries could be turning to Canadian oil instead.
What our allies have told us over and over again is they want a reliable, a secure, and a sustainable source of energy going forward.
On the flip side, some analysts predict the price of gas will go up by 5 cents on Wednesday, while diesel could jump by as much as 14 cents per liter.
The impact will be, certainly inflationary, and it could have that undesirable effect of maintaining higher interest rates for a much longer period of time.
That's because higher fuel costs will likely be passed on to consumers, meaning everything transported by truck, from apples to zucchini, will end up costing you more.
That was CTV's Mike Licouteur. Well, it's been 4 days since the U.S. launched that initial attack on Iran. And CTV's Scott Hurst joins us now with the latest on what's happening with the war and what Canadians are experiencing. So, Scott, good to see you. Global Affairs is urging Canadians to avoid all travel to 10 countries, right, amid that widening conflict in the Middle East. What's the latest on that?
Lindsay, good morning. First, a warning from the U.S. president of bigger strikes to come as the U.S. and Israel continue to target Iran. In the meantime, Tehran and Iran-backed militias have now hit back against Israel, neighboring Gulf states, and also targeting oil and gas production in the region and threatened to upend shipping channels, as my colleague Mike Licouteur detailed in that previous report. Now, from the Canadian perspective, the escalation is having a destabilizing effect in the wider region, and the Canadian government has since updated its travel advice and advisories to more than a dozen countries in the Middle East, urging Canadians to either avoid non-essential travel or all travel to these countries because of the recent flare-up of hostilities, Lindsay.
So the war in Iran also has sparked a secondary digital battlefield with misinformation spreading online like hours into the conflict, Scott. I'm wondering what Canadians can do to spot the difference between real and fake content online right now.
Lindsay, of course, we all know at this point in this day and age, video and information can be shared across the world in the snap of a finger. And already, just a few days into this conflict, we're seeing fake images and videos spreading online. And according to a digital investigator with whom CTV News spoke to, they're saying that they're seeing this across all platforms and multiple languages. And it is something that is spreading faster than anyone can really debunk. So really, the advice for Canadians is if you have any doubt, don't share it. Don't continue to fuel the misinformation. Also, some good advice, according to those who track these videos, read the comments. A lot of time, other users may have had similar questions and have since been able to track the original source of a video, whether it's real or fake or has already been circulating for several years. Also, potentially do a quick little research yourself, Lindsay. Open up another tab and try to verify the original source of the video. A little bit of advice there so that we're not caught up in misinformation throughout this escalating conflict.
Yeah, important to do our own investigating as well. Okay, that is CTV's Scott Hurst. Scott, thanks for that.
Thanks, Lindsay.
Up next, we'll hear from Tim Hodgson, Canada's Minister of Energy and Natural Resources, to get an update on the progress for Canada's major projects and an outlook on the strategy moving forward. Stay with us. As trade tensions with the U.S. rise, there is fresh pressure on Canada to speed up major energy and resource projects. Our own Andrew Bell spoke with Tim Hodgson, Minister of Energy and Natural Resources, for more.
We are in a new world order. The Prime Minister has been thinking about this for quite some time. His speech at Davos was really an articulation of what he has been seeing for the last year, and how he thinks we can tackle that. And I think the thing that made that speech so special to so many people was not just that he laid out in a way that people could understand what was happening and why people were feeling the angst they were feeling, but he also laid out a solution which was middle powers like Canada need to retool their economies, need to become less reliant on the hegemons, need to stop the scenario where hegemons use our integration with them for economic coercion, by building new partnerships, by building new trading relationships, by building new infrastructure that puts cards in our hands in this geopolitical world. And that is resonating with our allies around the world, and that's what makes this such a special moment, because critical minerals are the cards that we have that differentiate us in the world.
Although, in a way, it's more about the processing, isn't it? That's when the real value is added. Now, I know you're backing processing in this country, but it's going to take an awful long time to catch up with the Chinese. I mean, all the metal smelters are in Korea, Japan, China, and we're not building smelters yet in this country.
So what's happened is in other countries, their smelters have closed. We've kept ours open.
Some smelters, yes.
We have kept some of them open, and we're now reinvesting in those smelters, and we're taking advantage of core Canadian technologies around how to extract some of the critical minerals the world so desperately needs from our copper smelters, from our zinc smelters, from our nickel smelters, and that is differentiating us in the world.
You announced today a bunch of projects you're backing. Some are interesting. It's extracting minerals from old mining sites, at least one of them is. You said this will unlock, your government said it will unlock about $12 billion in private sector investment. One thing I'm always curious about, though, say you give 10, 20 million in support to a project. I don't recall seeing press releases, oh, well, this one failed, and we had to write off the investment.
Look, part of the role that the government plays is we want to provide capital where there are market failures. So we do things like our Canada Growth Fund provides first-of-a-kind risk. We finance that. That's hard to finance in the private sector. Taking that first-of-a-kind risk means that Canadian technology gets developed, gets proved out, and then we get to sell it to the rest of the world. We're doing that with some of the new smelting technologies that Crawford Nickel is talking about. We're looking at some new technology that Foran Copper is going to use. Those types of investments, they don't always pan out. We're doing work with Saskatchewan Research Council, which is, we're doing work with UCOR. We're doing work with some of the other refiners of heavy rare earth metals that is going to differentiate Canada and put cards in our hand.
Yeah, and obviously some of the stuff is going to fail. Mining is notoriously difficult. This is another discussion, but I sometimes wonder if the government should do a better job of admitting when things have failed. But you can't. Yeah, sometimes it's we can't talk about that. It's commercial confidentiality.
So I'm not sure which particular one you're talking about, but
Bombardier. A lot of money was lost in that fraud in South Africa involving Bombardier and the Gupta brothers.
Yeah, but that's not a metals and mining.
No, okay. So, yeah.
I'm focused on metals and mining here.
For sure you are. And as former head of Goldman Sachs, you know about raising money. And this kind of metal processing, it can be tough to actually attract capital, the early stages anyway.
Absolutely, it can be, and that's why we have things like our first and last mile fund to create the infrastructure that would allow that processing to happen. That's why we've got our Critical Minerals Sovereign Fund, which is designed to do offtake agreements, provide potentially stockpiling under our Defense Security Act. Those types of things give market certainty to attract that capital. These are all tools that we're going to deploy to make sure that Canada not only leads in the production of critical minerals, but leads in the processing of those critical minerals as well.
What would you say? I know it's hard to, your job, you've got so much to do. It's not an easy job. But do you spend most of your time on energy or other natural resources, would you say?
I am the Minister of Energy and Natural Resources, so I do both.
Yes.
Look, I am incredibly fortunate that Canada is endowed with incredible conventional and clean energy and critical minerals and forestry that differentiates us with almost any other country in the world.
Certainly G7 countries, yeah.
What I find as I go around the world is they all want what we have. Today, energy security is national security. Secure critical mineral supply chains is national security, is sovereignty. And we have that. This is our moment. This is our moment to shine. The world wants what we need. We need to develop that. So we thrive in this world where hegemons want to behave in a way where they want to do as they may and have the weak do as they must. We can never be in that situation.
That was Tim Hodgson, Minister of Energy and Natural Resources. Okay, we're going to take a look at the price of oil quickly before the opening bell, which is just moments away. WTI oil up by 8% today, more than 8%. Obviously, oil is surging. This is for the second day we've seen this vast increase in prices after the conflict in the Middle East. Iran's Revolutionary Guard says the Strait of Hormuz is closed now, so that's sparking fears that oil prices will continue to climb higher. We can take a look at the price of oil over the last week as well, and you can see just how much it's climbed over the last couple of days, ever since this conflict began over the weekend. Since Monday, you can see that surge in prices. If we take a look at Western Canadian Select, the differential with WTI narrowed yesterday as Western Canadian Select benefited from the Middle East war. You can see prices here up by 9% before the opening bell. And natural gas, significant volatility today, particularly in Europe after Qatar halted production at the world's largest natural gas export facility after it was targeted in an Iranian drone strike. So the price of natural gas up by 7%. Opening bells are next. We'll be right back. And here are the opening bells at the NASDAQ. Intuitive Surgical is ringing the opening bell this morning. At the New York Stock Exchange, Sunbelt Rentals rings the opening bell. And on the TSX, Latin American Mining Delegation opens the market in celebration of the Prospectors and Developers Association of Canada 2026 convention. It's time for the first 15. This is BNN Bloomberg. Trading is just getting underway. So we're going to check in on the equity markets to start the day now that the opening bell has rung. You can see the TSX, the S&P 500, and the NASDAQ all trading down to start the day. Of course, investors watching very closely these tensions in the Middle East, particularly between the U.S., Iran, and Israel, waiting to see what happens there. It seems there's a bit of a sell-off this morning. But again, just like yesterday, we could see that change as we move through the day. We're going to take a look at some Canadian stocks that we're going to be watching for today and talking about, starting with Pet Value. This is one company we're watching because its adjusted EBITDA missed estimates in its fourth quarter results, but profit is up from a year earlier. The company also said in its fourth quarter report that it's raising the dividend to 13 cents a share, up from 12 cents a share. So far, though, down more than 7% to start the day. So we'll continue watching that one. Roots is another company that we're watching closely today. This company says it's launching a strategic review with a number of alternatives, including a sale of Roots. So we'll continue watching that, currently up by more than 5% to start the day. Also watching Allied Gold. This finished top of the TSX yesterday as gold prices continued to climb. Of course, gold seeing a bit of a sell-off this morning amidst all the uncertainty around what's happening in the Middle East. So Allied Gold obviously down ever so slightly to start the day, but we'll keep watching that for you. And then if we take a look at some U.S. stocks that we're watching today as well, Best Buy is climbing after the big box electronics retailer posted fourth quarter results and providing guidance. Target is also higher after the company forecasts better than expected profit for the full year, indicating that the big box retailers' turnaround plans are generating results. And we're also watching Target, which is trading down at the moment by 0.5%. Coming up, MongoDB is under pressure despite a fourth quarter beat, and Target is trending slightly higher after reporting a drop in quarterly profit. We will tell you why right after this. Stay with us. Target reported a drop in quarterly profit and its 13th week consecutive quarter of weak or falling sales. But the retailer's new CEO has unveiled a turnaround plan, and investors appear to like what they are hearing. So let's bring in Michelle O'Connell, president of Portia Management Capital. It's good to have you join us.
Thanks, Lindsay, for having me.
Do you agree that this is probably good news for Target of a new CEO with a turnaround plan? What do you think?
Yes, I've been watching this stock for a while, and full disclosure, I do own it in several client accounts. The stock has done very well year to date. It's up 17%. I think the stock had gotten a little bit ahead of itself, and that's why you're seeing some weakness today. But long term, I think the new CEO is doing a good job of getting them back on track. They took up guidance a bit, which of course is good. Now they just need to start working on their apparel and some other areas of the store where they had differentiated themselves from Walmart, because that had been the issue, that Walmart had been taking their share because they've just been so competitive, and they had been more aggressive in terms of building out their AI supply chain.
Is that the biggest headwind you see for Target? Because you say they have a lot of work ahead of them. Is that mostly it, is differentiating themselves from some of the competition?
Yes, I owned this stock several years ago when I was a retail analyst. And, you know, they were always really good when you walked in the store and you were just there for a regular shop and you were there with your family to buy groceries. Your eyes always went to their products, especially the apparel, which was really reasonably priced, you know, for middle class and lower middle class families. And they've kind of had an issue in that area where they're just not having as much traction. But I think they're going to get there. It's just, you know, it's wait and see. I'm encouraged that they did take up estimates. Their same store sales also don't seem as soft.
Okay, let's turn to Best Buy because it is down 7% for the year. Earnings were mixed. Stock is going up, I believe, today. Let's take a look at the chart again because I forget. But what are your thoughts on Best Buy? Yeah, stock's up by more than 6%. Thoughts on this company and their latest earnings report?
Yeah, they're down 7% for the year. And it's still a show me story. They're not as advanced in a turnaround. I don't even know if I'd classify them a turnaround. Their hope for this year is the electronic side of their business will start to pick up again because we're seeing more rollouts with Apple's mobile phones, and Nintendo has a lot of new products coming on board. So that's what most investors have been focusing on. But they still have a lot of weakness in the electronic sector. And we have to keep in mind that a lot of people are feeling pinched in terms of their budgets, and 40% of consumers don't have any discretionary income. So I don't know how many are going to go to Best Buy to buy the latest and greatest phone or Nintendo.
Moving on to MongoDB. This is an interesting story. The stock is crashing after Q4 results. What happened? Why is the stock going down so much?
I think it's getting totally crushed for two reasons. It's in the software space, right? So software in general is off like 30% if you look at the sector. And this stock before this huge pullback was selling at a 45 multiple on their forward earnings or on this year's earnings. And they've got a huge amount of competitors that are larger than them, Oracle, Google, and Microsoft. And so disappointing in taking their earnings or their estimates down for the year, as well as having an executive shakeup with their chief revenue officer and somebody else. I think that was just the perfect storm to say, you know what, I'm out as an investor.
It's interesting, like we keep having this conversation about which software stocks will maybe thrive because of AI or be helped because of AI and which might be made redundant because of AI. What do you see happening with MongoDB?
I wouldn't own it. That's just me. I see so many huge competitors in that space, and I do own several software stocks outright because I feel that they have an advantage and that they are not going to be displaced by Anthropic. But I think this is one where I'm not willing to take the risk.
What software stocks do you like?
I like Okta. I'm cautious about ServiceNow and Salesforce. You had Anthropic say that several of the stocks that I just mentioned, they're going to use them in their plugins, so they're not going to be displaced. They're going to be working side by Anthropic. So I think investors need to really go through very carefully and see where the position is in terms of competition, because you're going to have some winners. AI is not going to take out all of software, but you have to be very strategic and careful and make sure that company is still going to be growing earnings 3 to 5 years down the line.
Okay, that sector aside, you believe now is a good time to invest in commodities. Is that right? And in particular, which kind of commodities are you looking at?
I like timber and I like metals. I like commodities because when you have the volatility like we're having now, that's the one area that's negatively correlated that holds up or actually goes up in value when the markets are being hurt. I like the fact that central banks are still buying more gold. And again, the volatility, anytime we have some volatility, and also the fact that we need more of these commodities to have build outs, whether it's AI data centers or in the States, and I think also for Canada, we need more homes to be built. There just there's not enough supply. So copper is used a lot in home building, and obviously timber is as well.
Interesting stuff. Okay, we will leave it there. That's Michelle Connell, President of Portia Management Capital, joining us. Thanks so much for your time.
Thank you, Lindsay.
Yesterday on Market Call, we were joined by John O'Connell, CEO of Davis Ray, and he was covering North American large caps. These were his top picks: JP Morgan Chase, American Express, and Charter Communications. Today on the show, we have Keith Richards. He is the president and chief portfolio manager of Value Trend Wealth Management, and he will be taking questions on technical analysis. So be sure to stay tuned for that. Coming up, we'll head back to PDAC in Toronto and catch up with our Andrew Bell, who is live at the conference. Stay with us. Welcome back. Our Andrew Bell is at the PDAC Mineral Exploration and Mining Convention in Toronto today, catching up with some of the sector's most influential voices. So we are going to go to him now. Andy.
Hey, thanks very much, Lindsay. Yep, live at PDAC, world's #1 mining fest. We've got Sean Usmar. He's CEO of Vale Base Metals. It's great to see you again.
Great to see you too.
So just remind us, Salobo in Brazil is your flagship asset. We'll start off with copper, because I know you're huge in nickel as well. But of your copper production, how much would come from Salobo?
So we did 382,000 tons last year. I think we're one of 2 companies that exceeded guidance in both metals. But we did about 219,000 just in Salobo last year and nearly 400,000 ounces of gold.
400,000 ounces.
It's a lot of gold for a copper company.
Quite a bit of that gold, though, gets bought by Randy Smallwood of Wheaton Precious Metals.
We've done him well this last year.
He's been happy with that.
He should be,
Then where else do you get copper from, just to sort that out?
So in Brazil in particular, we've got Sossego, which they've hit their biggest numbers since 2022 last year, a record at Salobo. And then we've got polymetallics in Sudbury, and we did about 90,000 in Canada just with our nickel ore bodies. Only about a third of our revenue in Sudbury now is nickel. What? The rest is copper, cobalt, and PGMs, gold.
But can you flip around in Sudbury? Is that can you boost your nickel and cut your copper?
There are different ore bodies which have different sort of splits. So, for example, you saw we announced late last year the framework with Glencore on Nickel Rim South. That's more copper rich.
Sorry. Is that reviving a mine or a new
no,
thing?
So it's leveraging existing infrastructure that is now in a depleted part of their footprint. So they've got some of the best shaft infrastructure in the basin. We've got contiguous ore bodies, Sudbury synergies. So the idea is to maybe deepen that by about 700 feet and drift across to our ore bodies. And we save capital that we otherwise would have to invest. They access our ore bodies, and it's a 50-50 joint venture that we're pursuing.
So copper, pretty profitable right now. It's roughly $10,000, $11,000 US a ton in London, and your cost is below 1,500, 1,500.
We were below 1,000. We actually lowered guidance at Q3 last year, and we were below the low end of cost guidance last year.
So you've got pretty good cash flow right now from copper?
Yes, we do.
And then what about nickel? I mean, you're almost better known for nickel because of Sudbury. How much nickel do you produce, roughly?
We've been producing over 100 years, and so this year we're guiding to 175 to 200,000 tons. There's opportunity for more, but we don't want to oversupply the market. And the focus there is we've dramatically lowered cost, and we're really maximizing the throughput through our vertically integrated facilities in Sudbury and in Voisey's Long Harbour, and that's the focus on making sure we're competitive through the cycle.
What do you have in Long Harbour in Newfoundland? Is that a smelter or a refinery?
It's a hydrometallurgical facility there which processes exclusively the Voisey's Bay material with some custom feed.
Big question, obviously, the IPO. Do you have any plans for the possible spin-off from Vale in the near term?
Yeah, I was excited to share with you when we last spoke a few months ago. You could see our results coming out, but we beat guidance. We were nearly $900 million better off on cash flow last year, and about 60% of that was through cost improvements, productivity, volumes. So the idea is to get the business IPO ready for our owners, which we're aiming to do around the middle of this year, and to maximize their degrees of choice. They can continue. I know Gustavo is very much focused on unlocking and being patient on the copper growth in Brazil in particular. And we've dramatically lowered our capital intensity on those projects and also accelerated the pipeline. We'll do about $3.5 billion over the next 5 years just on copper in that area.
Spending or cash flow?
No, spending and investment in 3 projects, and then we're looking to double through 2035. But those returns with the approach that we've taken now have gone from mid-teens to some cases over 60%. So we're really focusing on how do we bring it online, continue to operate responsibly, and make our nickel business robust through the cycle.
What do the investment bankers tell you? I guess they say do it now. They want the fees.
I think it's an unusual window right now, and I do believe our business is performing, but we're not the owners. Our job is to be able to present choice to them. And I think we're 2 years ahead of what I thought my team could achieve. We went from 24 billion, 3 of EBITDA. Last year was 3.3. And if you look at just our guidance this year in this sort of price environment, we're materially further ahead on that. And if you put a multiple on, you can get a sense of the value of this portfolio, which is not reflected yet in Vale's share price. So we'll have an investor day at the end of March in Toronto to be able to actually showcase some of the technical work we're doing and to help the market understand just how valuable this portfolio is.
Sorry, so you're at about 3.3 billion in EBITDA right now?
That was last year.
Okay.
Oh yeah, no, our run rate is well ahead of that.
What kind of a multiple would an IPO be at?
So if you just think about comps, think about peers normally trade around, let's say diversifieds, maybe in that 5 to 6 times EV/EBITDA multiple. Pure players are more like 6 to 10, some higher. So we can dream. But you can do that math.
Yes. What about cobalt? What about these so-called strategic metals? You're so big, and they're very small markets in some cases.
Yeah, cobalt's interesting, right? It's always been historically very dominated by the overhang of supply coming out of the DRC. It is a polymetallic, lucrative revenue stream for us coming out of Sudbury and in Voisey's.
Oh, you get some cobalt.
Yeah, we get significant cobalt that comes out of there. And, you know, we've seen the government, the DRC, like we've seen with the Indonesians, constrain supply, and that's had a significant impact on supply and demand and pricing. But, you know, we produce, you know, really significant volumes of cobalt, but it's a byproduct for us.
Right. How much of the global market would you have in cobalt?
It's not material in the grand scheme. But I think we're one of a few accredited suppliers into the defense and aerospace side, for example, in the US.
And have you been dealing with governments around the world trying to stockpile this stuff? Have you found yourself talking to defense types?
Look, we provide, I think I might have mentioned to you last, I think our Sudbury operations provided 95% of all the nickel in World War II to all the allies. We do about 60% of the nickel to aerospace and defense. So our priority is continuing to service our customers around the globe because we go from Japan, Indonesia, Wales, all over Canada and Brazil. And so we have a platform that allows us to serve customers all over the globe. But governments are very much in the conversation, as you'd imagine, in this moment with supply chains.
It's interesting. For decades after, we'll just get copper or China to supply us with metals, for example. The attitude has changed.
Yeah, I think you know, we've had a global supply chain that has worked in a very efficient, cost-effective way for a long time. But we've seen the vulnerabilities starting to appear, and I think people are reconnecting with just where these supply chains come from, and you know, we have a role to play there, which is important.
And Indonesia is trying to get that nickel price up by restricting supply?
Yeah, quite dramatically. It's only the last handful of months, but you know, the back end of last year we started seeing that move. They've been, I think, quite direct with their messaging and some of their actions with their cutbacks on RKABs, I think down to 250 from numbers that were materially higher last year. So you've seen the market respond. And you know, for us though, our business in Canada has so much potential, but it's been going for over 100 years. But we've got to make sure that regardless of policy changes elsewhere, we have to make sure we're in that lower half of the cost curve so that through the cycle we're resilient. And that's the focus. We're not there yet, but we've made last year alone, overhead was about $250 million lower in our nickel business. We were at 27% on our all-in costs lower in nickel and 77% on copper last year. So huge numbers, but we've got further to go on nickel.
Sean, thanks very much.
Thank you.
Sean Osmar is the CEO of Vale Base Metals. Back to you.
Okay, that's BNN Bloomberg's Andy Bell. Andy, thanks so much for that conversation. Up next, Prime Minister Mark Carney has landed in Sydney, Australia, the second stop on his 10-day trade tour following constructive meetings in India. And we'll dive into this trip coming up after the break. Prime Minister Mark Carney has arrived in Sydney, Australia, a second country on his 10-day trade tour. He's expected to address Australia's parliament during the trip. And for the latest, we are joined by CTV's Annie Bergeron-Oliver. Annie, good to see you. So let's start with, I know he's in Australia now, but just going back to that trip he took to India, the first in a long time, you know, warming up relations there. There's been a landmark nuclear energy deal reached with India and a further commitment to finalizing a new trade deal later this year. But it's tricky because how are these developments playing out as CSIS still maintains India's involvement of foreign interference here in Canada?
Well, there are definitely still some questions about whether this is the right move for Canada, about whether Canada should be moving closer to this big economic power at a time when there are still very real questions about whether India is engaged in foreign interference and transnational repression in Canada. Members of the Sikh community say absolutely not. There was a press conference just last week saying that Canada should not be doing big deals with India until this is solved, until there is a guarantee that India is not meddling in Canadian affairs. When it comes to the federal government, they're kind of saying a very similar line to what we heard about China, which is we have to do business with eyes wide open. They're saying essentially that the economic partnerships are separate from kind of some of those democratic questions, that we can have economic partnerships with countries like India and with China, but also kind of talk about very sensitive and difficult subjects at the same time. So this is a really interesting perspective. But when you come to sort of just this big uranium deal, Saskatchewan's Scott Moe, for example, is saying that this is a great deal for Canada, great deal for Saskatchewan. It means $2.6 billion in deals with India to supply uranium from a Saskatchewan company, Cameco, over the next 10 years. There's a lot of others who are saying, look, this creates a lot of jobs for Canadians. This really does help diversify the Canadian economy. And that's what the federal government is saying as well. But again, while analysts and the government are saying that these are great deals, that they will provide a lot of jobs, and this economic relationship is a good thing with India, there are lots of people who are also saying, well, we need to get to the bottom of whether India is still actively engaged in foreign interference, and are the safeguards in place enough? The government seems to say, yes, we do have these safeguards. We have conversations in place at all of the highest levels to ensure that this doesn't happen. But we're also hearing still from the security agencies that they are concerned about India involved actively in domestic issues in Canada.
Okay, so let's move on to this next leg of the trip. Prime Minister Mark Carney now in Australia, as we mentioned. So both Canada, Australia, Commonwealth nations, but there are some areas where the two sides can kind of strengthen their relationship. Is that right? Like, what can we expect from this part of the tour?
Yeah, this part of the tour is really just all about showing the world and showing Australians that Canada is prioritizing this relationship. The two countries have been allies for a very long time. We work together on security when it comes to Five Eyes. We're both members of the Indo-Pacific nations. But the relationship hasn't been important. Justin Trudeau in his 10 years was never there. So this is all about trying to secure a better relationship with Australia, as well as with Australian businesses, to try to convince them to invest more heavily in Canada.
Okay, that is CTV News. Annie Bergeron-Oliver reporting for us. Annie, thanks for that.
Thank you.
Just ahead, we've got earnings from Pet Value and some ideas for your portfolio. So stick with us. We'll be right back in a moment. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney has landed in Australia after wrapping up his trade trip to India. Carney is expected to meet business leaders in Sydney as Canada seeks to build on strong intelligence ties by broadening collaboration in defence and trade. Carney will also meet with Australian Prime Minister Anthony Albanese and will address the Australian Parliament before leaving for Tokyo. Shares of Roots are trading higher. That is after the Canadian clothing retailer said it is exploring a strategic review that may lead to a sale of the company. Roots says the move is to analyze options in order to boost value for shareholders. And Saudi Arabian oil giant Aramco is seeking to reroute crude away from the Strait of Hormuz as the route remains closed due to the escalating war in the Middle East. According to reports, the world's biggest oil exporter is exploring the option of delivering more cargoes to a port in the Red Sea. The move is aimed at avoiding production cuts, and the reports come after Aramco was forced to shut its biggest refinery after a drone strike. We'll take a quick look at the markets here. The TSX is trading down this morning. Wow, it's down below 34,000 once again after reaching that record high last week. Currently down by more than 3% at the moment. Seems to be a similar story if we look at markets south of the border. Yeah, the S&P 500, Dow Jones, and the Nasdaq all down by more than 2% to start the morning. We saw this yesterday morning as well. Investors a little uneasy about what's happening in the Middle East. We'll have to wait and see if there's any rebounds throughout the day. Pet Value has reported a fourth quarter profit up from a year earlier and raised its dividend, but our next guest has a hold on the stock. So joining me now in studio is Lauren Steinberg, co-president of Lauren Steinberg Wealth Management. It's good to have you join us.
Great to be here. Thank you so much.
So let's start with Pet Value then. Why you still have a hold on this company? Why is that?
Sure. The reason is, the revenues weren't as great as they looked because there was an extra week in last year's comps. So revenues were actually up about 3.5% on a comparable basis. Same-store sales are almost flattish, And so the company is, gaining revenue growth by opening more stores, but it's still in a pretty tough space. It's a pretty tough retail environment, and there's still pricing pressure. So we wouldn't be going out there to buy the shares today.
Well, I mean, what are the main challenges? Like pet value down today more than 10%. What are the main challenges for a company like this?
First of all, I think one of the big challenges is that there is pet food being sold everywhere.
True.
So you can buy high-end pet food in Metro and Loblaws and that kind of thing, and in dollar stores there's lower brands. There's so much competition in this market. Yes, they're a specialist, but it's so easy for a shopper with a pet to buy their groceries and get their pet food at the same time. That's a serious issue for this company.
What do they need to do? Sorry, I'll move on eventually. I may or may not have a pet myself, so I'm curious. Like, what do they need to do to kind of diversify and make themselves different than some of that competition?
So, I mean, they have, of course, a massive amount of SKUs versus everybody else. And if you want toys and other things, you can get them there. But pet food remains one of the, places where people really go most often. You're not buying a toy every day for your pet. Mm-hmm. So, I mean, they're opening stores, which is their driver, but they're just in a very tough space, and it's more, management might be doing a very good job. It's just a tough space to make money.
For sure. Okay, so let's move on then. Target, you have Target at a sell. Target doing well with an upbeat forecast. Why do you have this one at a sell?
Sure. So first of all, Target has shown a little bit of improvement, but fourth quarter sales were still negative. And even with some improvement and a very bullish CEO, let me say, they're forecasting revenue growth this year of only 2%. So pretty flattish. Yes, they might get some and wide earnings guidance as well, which indicates, depending on their mix and their ability to buy well, will they be able to get any significant growth? We don't really think so. Retail is a really tough space, as we know, outside of places in the U.S. like Costco and Walmart, and of course Amazon killing everybody. So there's no growth there.
Yeah, even though they have, like, as you say, this new CEO, there's that turnaround plan. Doesn't really excite you.
And there's a difference between a plan. We've seen this before,
right.
But the actual growth is really tough to come by, and it remains a really tough space.
You have Best Buy at a hold. What do you think about this?
So interesting, Target and Best Buy both had declining sales in the fourth quarter. And Best Buy, again, is indicating their guidance for the coming year of either -1% to +1% revenue growth, which is basically flat. Again, an indication of how tough things are. We think Best Buy has a little bit more momentum and sales opportunity because in the electronics space, new products coming out from Nintendo, constant flow of Apple gear and things like that, probably will give them some boost. And so, we wouldn't be ready to give up on it, but we don't own these stocks, and we just think there's better places to be.
Okay, so we've got some stock picks. I want to go through some of them. I feel like I don't know how to pronounce the first one. Is it Unilever?
It's Unilever.
Okay, Unilever. What is this company? What do you like about it?
So Unilever is a huge global consumer products company. Things like Dove soap, as an example, Irish Spring, and things like that. Unilever spun off its ice cream business recently, and so which really didn't fit with the company as a whole. But this company has been delivering earnings growth, revenue growth, executing incredibly well. You're getting a 3.2% dividend, which will grow continuously, and they're incredibly well positioned. And consumer stocks have lagged, and so we like the sector in general. And Unilever is just a major global.
Okay, next up is Kimberly-Clark.
So Kimberly's an interesting company. They make, of course, bathroom tissue and Kleenex and things like that.
Yeah.
But they're undergoing a major merger with Kenvue. Kenvue is the old Johnson & Johnson consumer products company. So products like, Neutrogena, Aveeno, Johnson's Baby, et cetera. And that merger should provide incredible synergies. The stock is trading near a 10-year low. You're getting a 4.7% dividend yield. And just the cost synergies alone, we figure we can get, double-digit earnings growth from this company with a trading at a very low multiple.
Interesting. Your next one, I think most people know this company, McDonald's. The CEO, of course, going through some more superficial, I think, issues at the moment. But what do you like about McDonald's and kind of their outlook for the year?
So first of all, McDonald's is the best in the business, best quality control, continued growth. But McDonald's is not your father's McDonald's, if I can say that. because McDonald's made a move into coffee, which is very, very high margin. And, McCafés are selling, espressos and lattes and the like. They're now getting into energy type drinks, in your coffee like Starbucks is. They're priced, of course, below Starbucks, but they're driving growth. And we're looking for McDonald's to deliver double-digit earnings growth for the next few years with a 2.2% dividend yield. But McDonald's is become a double-digit earnings grower again, trading at a very attractive multiple. And you have a chance to buy the best. And there is a value, to be paid for quality. And there is nothing like this company in the fast food sector.
Wow. Okay. And Nike is another one. Nike's had some interesting partnerships lately. What do you like about
So Nike is definitely in turnaround phase.
Yeah.
The stock is depressed, but they have virtually zero debt. And they've turned the corner. They are gaining shelf space. Their CEO is a year and a half into this turnaround. And we're looking for Nike's earnings to double in the next 2 years, off a very low base for sure. But boy, they are poised to really take off, and the stock is trading at a compelling valuation.
Okay, so we'll get to a couple more of your picks. Starbucks, I mean, you just mentioned McDonald's, and you kind of referenced it in relation to Starbucks. So what do you like about Starbucks?
So Starbucks, they are also a year and a half to turn around, and their earnings should double in the next 3 years. Listen, the CEO has done what they can, what they needed to do, one of which is adding an assistant manager to every single store to speed things up. Starbucks margins are second to none. The person who spends $7 on a pumpkin spice latte doesn't mind spending $7.20 if costs go up. And so Starbucks experienced, revenue growth, same-store sales growth for the first time last quarter in the last 2 years. So they are well along this path, and they are unique. As well, people with the Starbucks app load money on. Starbucks is sitting with a few $1 billion on their Starbucks app and making over $100 million a year, roughly, in interest.
Okay, just before we wrap up here, I just wanted to get to one more note. Obviously, we're following kind of just like a broader market development here, particularly with what's happening in the Middle East. You say investors should remain invested and not react to the daily news cycle. What do you mean by that?
So first of all, even though the market is down a lot in points, it's only down about 2% today. Yesterday, it wasn't down very much. I think the reality is investors should assume that, 3 months from now, we'll probably be past a lot of this, as has been indicated by policymakers, and the focus will always remain on corporate earnings. And we are forecasting, double-digit corporate earnings growth in North America this year, and that should bolster markets.
Okay, we'll have to leave it there. We're out of time, but appreciate you coming in studio as always. Thank you.
I very much appreciate being here.
Thanks. That's Lauren Steinberg. Coming up next, we will head to the PDAC floor to discuss how Canada is positioning itself as a global leader in rare earth and critical minerals. That's coming up. Stay with us. It is time now for the ETF report. Canadian ETFs are proving popular among investors. And so for some ideas, let's go to Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. It's good to have you join us.
Thank you for having me.
So I do want to get to some Canadian ETFs, but just first of all, after what we saw over the weekend and into the first couple of days with these strikes in Iran and Iran retaliating, what fund flows are you seeing after this all kind of went down?
Yeah, exactly. So we had Monday to kind of digest this news that happened over the weekend and saw a mixed bag in ETF fund flows. But actually, I would say that it was kind of like cautiously optimistic in the flows. We saw kind of broad-based equity buying, of course, defense and aerospace ETFs saw strong fund flows yesterday. We also saw kind of bifurcated activity in the fixed income space. So that was a lot of buying in ultra-short treasuries. So that's 0 to 3 month duration. This is very much a safety trade. But we also saw a lot of inflows and buying activity on the long end of the curve. This ETF is called TLT. It had strong inflows, and I think this is kind of a bet on this being an potentially inflationary event, and investors or traders trying to get ahead of that as well.
Interesting. When it comes to Canadian ETFs that you see as being popular right now, which ones are you seeing the most?
The trends in Canada have really been broad-based. So far in 2026, really see a lot of interest in international equities. This is, again, part of the broadening rotation trade, people kind of looking outside of the U.S. and looking for other avenues to really find that alpha in this mixed market with kind of contrarian signals. And then, of course, a lot of headline risk and now geopolitical uncertainties as well.
I know you flagged a couple of ETFs in particular, so we'll go through those. When it comes to Canadian energy, the BMO Spider Energy Select Sector Index ETF, what do you like about this one?
Yeah, so this holds the energy sector in the U.S., and this was to start a valuation call. Listen, when we looked at energy sector in the U.S. versus all the other GIC sectors, we thought that there was some value opportunity in the energy space with, of course, some positive momentum on the earnings side as well. Now we have this geopolitical strife. We have, obviously, commodities rallying on the back of that. This will no doubt be a tailwind for the sector as well. But primarily, when we initiated a recommendation here, it was a valuation play.
Okay, we're going to stay in the U.S.-Canada energy sector for a moment because State Street Energy Select Sector Spider ETF, another one of your picks. What do you like about this one?
This is the same. It's the same. Yeah, it's the exact same. It's just it's the U.S. listed version, and the BMO Spider is the Canadian listed version.
Got it. Okay, so we'll move on to the next one then. Morningstar International Value Index ETF. You might have mentioned this off the top. I don't know if you did, but can you go into more detail about this one?
Yeah, absolutely. So this is actually, we've seen a shift of interest into a value factor ETF. So these ETFs, again, are kind of looking at valuation first and foremost before they go through the screening stock selection process. And as we think about AI jitters in the market, valuation on Mag 7 or other software-related companies, maybe there's some concerns around valuations. If you pick an ETF that has a value bent to a tilt to it, then you're kind of looking at a different pocket of the market. And we think, again, there's some compelling reasons to think about that consideration given the current market setup, and there could be opportunity there to see some re-rating, some valuation improvements, and then ultimately some alpha generation looking at international value stocks.
And lastly, for a high dividend, you've got the Fidelity International High Dividend ETF.
Yes, again, so we're keeping an international tilt to these recommendations, kind of, again, broadening that exposure. And then we like quality dividends, so kind of putting those both together that skews higher quality companies. But in an environment where we think that broadly rates are going to be in hold for this foreseeable future, we need to look for other ways to diversify income and kind of search out that yield. And we thought that adding a quality international high dividend index would be an interesting way to seek out additional income in the current market setup.
When you talk about that, like central banks broadly holding rates steady, you say your economics team is flagging a stagflation-light environment. So
yes.
What do you mean by that?
Yeah, so we're kind of, again, this is, I don't want to speak out of turn here because this is my economics department, but what they mean by that is really kind of sticky inflation, growth moderating, some push and pull dynamics, and they talk a lot about a K-shaped economy going forward as well. So that's really the higher end of that K kind of carrying the economy. That's the higher net worth consumers and kind of these different mixed signals at play going forward.
You also have been watching some Bitcoin ETFs. You say they've been remarkably resilient so far this year. Why is that?
They've been resilient in the holdings and the lack of outflows. So obviously there's been a big negative price move in Bitcoin, but the Bitcoin ETF holders have been remarkably resilient in not selling out of their positions and keeping this allocation within the ETF sleeve. And so what that really tells us is that people are using the ETF, the Bitcoin ETF, as a way to express that allocation, and they haven't panicked in the face of this very dramatic move to the downside.
And is that specific to Canadian Bitcoin ETFs?
It's actually both. We've seen it here in Canada. Actually, here in Canada, I think we've seen net inflows into Bitcoin ETFs year to date. And in the U.S., they've been pretty flat. So neither really adding or subtracting. They're just kind of holding steady here at these current levels.
Okay, we will leave it there, but it's so good to get your insight on all this. Thanks so much for joining us.
Great, thanks for having me.
That's Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. Coming up, we will hear from Anna Bailau, CEO of Build Canada Homes, a national agency tasked with accelerating the construction of affordable housing across Canada. That's next. Stay with us. International Women's Day is coming up, and we took a look at a company led by women changing Canada's economy. Build Canada Homes is a national agency tasked with accelerating the construction of affordable homes across Canada. And for more, we sat down with Anna Bailau, CEO of Build Canada Homes.
It was announced by the Prime Minister September 14th. I started a couple of weeks after, so October 1st, so just 5 months. Some days it feels like 5 years, some days it feels like 5 minutes, to be honest with you, because there's so much to do.
You're going to tell me you haven't resolved everything yet, right? Is that's what you're going to say next? It is a challenge. Where do you even turn your attention first?
It is a big challenge. It's a challenge that the country has been facing for a significant amount of time. But for somebody that has been working in this area and in the housing sector for so long, it's really inspiring to see the momentum and commitment that is behind this organization in terms of the government and the partners as well. The nonprofit sector, the private sector, they want to come and work with Build Canada Homes. And that's where the solution lies. It's about partnerships with other orders of government, because there's not going to be one order of government that is going to solve this issue. We need all orders of government to work together to tackle housing. We need partners in the private sector, in the nonprofit sector, and we need to bring everybody with their best skills and their best tools to the table. And that's what Build Canada Homes is all about, is building a set of tools that the federal government has available. In this case, with Build Canada Homes, we're bringing land, public federal land, and we're bringing very flexible financial tools, which is really important, especially in the times that we live today. So we were initially capitalized with $13 billion, and we are deploying that money in flexible ways to make sure that we get shovels in the ground. And there's 3 key things that we need: speed, scale, and affordability.
All right, on those notes, Ryan?
Just curious, with the changing dynamics in the housing market, obviously the condo market in urban centers has softened significantly, and the immigration dynamics have changed. So just curious, where is the greatest need, and where are you guys focusing in terms of location and structure, I guess, to accomplish your goals?
Yeah, so we're focused on affordable housing. So there's a huge mismatch on the price of housing that Canadians can afford and what we have been able to produce. And it goes all the way from very deep transitional housing to what people call workforce housing. So that's the area that we're focusing, and that need is across the country. The flexibility that we have as Build Canada Homes is that we are able to respond to the most the largest needs in each community, because we don't have a program across the country. We are flexible enough to deploy our land and our financial tools in a way that responds to the local needs. But we see the need across the country in terms of affordability, and that's the area that we're really focusing. Deploying the $1 billion that the Prime Minister announced in transitional housing, deploying the workforce housing through our public lands and through the money that we have available for partnerships with the private sector and the nonprofit sector. We're actually seeing a lot of appetite because the market, as you mentioned, is slower in areas like Toronto, Vancouver is very, very slow. There's a lot of appetite from a lot of these firms, especially in the private sector, to come and work with us because they want their workers to work. They want to put their workers to work. They look a lot of them are looking at their projects and coming to us and saying, can we partner? Can we provide some affordable housing? Can we partner together to get shovels in the ground? So there's a lot of appetite to work with Build Canada Homes on both parts. We're very eager to get out there and to work with the private sector and with the nonprofit organizations because we're keen on making sure that we create capacity in the nonprofit sector. But there's an opportunity because the market is slower in certain parts of the country to actually scale up the affordability and the affordable housing.
All right, I'm just going to jump in with the private sector. I mean, obviously the big thing is profit, and I imagine they must have a fear of working with the government because of red tape and the bureaucracy slowing things down. Is any of that being reduced to help speed this up?
So that's one of the key things that Build Canada Homes is bringing to the table through our partnerships that we're doing with provinces and with municipalities. We're trying to push implementation tables to get these projects that we're getting involved approved quickly, even in areas that we don't have direct control in the approvals, but also through the flexibility that we have in deploying our funds. It's about making the project work. It's not about a long application that you have to check the boxes. It's about what is needed in this project to get shovels in the ground. So that's the advantage of Build Canada Homes, and the appetite that we have, and we're calling on our private sector partners and the other orders of government to come with even bigger portfolios, with a portfolio so that we can start not only looking at a project by project, but create a pipeline, because it's good for them. It gives them the certainty, is good for timing. It gives them speed on approval because they know it's coming. Mm-hmm. And it's good for the other part of our mandate, which is being a catalyst for modern methods of construction. Because what we've heard in a lot of these factories, that we need that pipeline. So the more of a pipeline we're able to create, the better.
All right. And just quickly, we're out of time, but are any projects officially started? Just very quickly, like 20 seconds.
Yeah. We have started in Nunavut. We have site servicing in most of our 6 sites. And there's a number of projects that are starting shovels in the ground over the next few months. We have already approved and are working on almost 9,000 units, with a few more to be announced over the next few weeks. And some of them have already have started with shovels in the ground, and we're particularly proud of the work that we've been doing in Nunavut.
That was Anna Bailau, CEO of Build Canada Homes, co-hosted by Ryan Bushell, CEO and Portfolio Manager at New Haven Asset Management. Coming up next, we will head to the PDAC floor to discuss how Canada is positioning itself as a global leader in rare earth and critical minerals. That's next. The price of aluminum is rising after Qatar's state-owned energy producer said it would halt output of the metal. The announcement comes as the Iran war continues to impact supply lines for metals throughout the Middle East. Iranian attacks have forced the shutdown of Qatar's energy's major LNG plant. Traders are bracing for widespread disruptions to supplies as the U.S. says there is no fixed timeline for its military action. Shares of Roots are trading higher today. That's after the Canadian clothing retailer said it's exploring a strategic review that may lead to a sale of the company. Roots says the move is to analyze options in order to boost value for shareholders. Roots opened its first location in Toronto in 1973 and has more than 200 stores across Canada and Asia. Meanwhile, shares of Pet Value are plunging today, down more than 13% right now. The pet food and supply retailer reported adjusted profit for its latest quarter that missed estimates and also posted revenue that came in below expectations. Pet Value's earnings and same-store sales also fell short of what analysts were expecting. One bright spot, though, is the company boosted its dividend by 8%. We'll take a quick look at North American markets this morning, all trading down. The TSX is down by almost 4% at the moment. S&P 500 down by more than 2%. The NASDAQ also down by 2.5%. Investors very wary about what's happening in the Middle East in that conflict with Iran, the U.S. and Israel, and watching things very closely. Okay, so let's head back to the conference floor at the PDAC Mineral Exploration and Mining Convention. That is where Andy Bell is standing by. Andy.
Lindsay, thanks very much. Live from PDAC. Once again, we are talking rare earths this time. We're here with David Lenonichuk, who is Global VP of Metallurgy and consulting at SGS, which is a massive Swiss-based firm. Just remind us very quickly what SGS does, please, David.
Yes, we're a leading testing, inspection, certification company. We work across every major supply chain around the world, 130 countries, and I'm in the mineral side of the business, and it's great being here at PDAC because it's an exciting time right now.
And one of SGS's specialties is building processing plant pilots to make sure that it'll work, the project.
Absolutely. We work in the mineral side. We work all the way across the supply chain. So all the way from exploration with our geologists, our mineralogists, but our specialty is on the process development side, and especially on the piloting to de-risk those difficult projects.
Which rare earths are, they're complicated to recycle.
Yeah, I mean,
or to produce, to process.
Rare earths are complex projects, so you need, like I said, great talent, and we're lucky to have fortunate with great bunch of metallurgists, chemists, chemical engineers, and process engineers as well.
So just remind us, around the world, by your reckoning, only about 2 serious rare earth production and processing facilities outside China are in the works. There's Lynas in Australia and then Mountain Pass in America.
Correct. I mean, with China, commanding some 90% of the refining for rare earths, that doesn't leave a lot of space for others, which is why everyone's focused on diversifying away from China. But the ones that have had the lead so far are Lynas and Mountain Pass. And that's why we see all these incentives now, all this discussion amongst the G7 to say, we have to do something different. Rare earths is obviously one that gets a lot of attention because of the fact that it could be a constrained supply chain and because of the fact that it's so closely tied to defense.
But does Canada really have a chance here? Because we don't have any big rare earth mines. I know we have some things on the boil, that one they've started up in Saskatoon for processing rare earths. But it sounds like we're really coming from behind the 8 ball here.
From a Canadian perspective, the best is to compare it to gold. So gold, high price, well-known, tons of projects. Canada has some 2,000 projects, all the way from prospecting to advanced studies. What's visible for rare earth projects in Canada, there's about 15 of them. And half of them are in the study stage. And so right now, with all this and all these new incentives, now that critical minerals and rare earths are under the Defense Production Act, that opens new tools for the Canadian government to use. They can enter offtakes. They can provide price support for commodities that they choose to. They can look at stockpiling. So these are new initiatives to develop these markets outside of China, not only for Canada, for its own domestic purposes, but also for allies who will use that downstream, because obviously Canada is going to have to look to other partners in terms of that downstream demand.
Things seem to happen so slowly here. You probably know all about Neo Performance, a Toronto company, and they just built a plant in Estonia. Apparently they did it in 500 days. And some players in the industry say, well, you can't even get a meeting with a Canadian minister in that time frame.
Well, it's a testament to the conviction that Neo Performance has. I know the team, and it's the fact that what they did in Europe is they actually went to talk to automotive players to get commitments to change their supply chain.
And they got a big offtake.
Because part of this is you have to change what you do. You need to change your partners, and you need commitments. And that's what they were able to do to get that, the fact that they had, like I said, those the necessary offtakes to justify that investment. But they were a good example of how we could change. They brought a magnet to the G7 meeting last year, and I believe it was the ambassador of the EU who presented it to Prime Minister Carney, just to show that we can make change. And that's what's in the air right now, and that's why I will say at PDAC, rare earths is one of the most talked about. It's hard to compete with high gold price, I will say that.
Yeah.
But in terms of things that are getting a lot of attention, and even the business, our lab is buzzing with activity, multi-commodity.
In Canada?
In Canada, because our rare earths, that's where our expertise lies. That's our center of excellence, is in Lakefield, celebrating its 85th birthday, by the way.
What's Lakefield, sorry?
Lakefield is our lab, our large lab in Ontario.
Yeah.
But we just celebrated our 85th anniversary.
Yeah.
But that's where all of our, like I said, our expertise in Canada lies in terms, like I said, those challenging rare earth projects develop, and when they need to be piloted at large scale, that's what we do because we help de-risk them while they're going through those advanced study stages.
I know the government just in the budget last year announced a $2 billion critical mineral fund, and Minister Hodgson yesterday announced various projects that the government says will unlock $12 billion in investment. Not all of them, of course, rare earths. But does Canadian industry even have an interest or the capital to invest here?
And that's a big part of their plan because both Prime Minister Carney and Minister Hodgson have said two things consistently. Actually, three things. Canada has what the world wants because of the G7 alliance coming together. And then you add NATO because the conflict is increasing in the world. These supply chains are constrained. So number one was, like I said, is Canada has what the world wants. Number two was that they're building their domestic supply chain. That is a commitment from Canada. It's diversifying its partners. But number three is getting that foreign direct investment. And that's when we look at the $12 billion dollars of investment announcements.
Some of those are foreign companies. A lot of them are. Yeah.
And that's why, because Canada's market is not large enough from a end use, it needs those diversified partners. And that's why we're seeing the trade side accelerate to leverage the fact that Canada is a powerhouse when it comes to this natural resource base that it wants to develop.
But I'm just wondering, I mean, we see Canadian IPOs are rare and companies keep getting bought off the TSX because of a low valuation. And our mining industry has been hollowed out. There's really no Canadian-controlled miners, big ones left.
What I can say is behind the scenes, ever since they opened up the Defense Production Act to put critical minerals and rare earths under that, it unlocked these new powers. It unlocked the $2 billion critical mineral sovereign fund. That means that we've seen industry come together, and behind the scenes, we're having a lot of discussions with Natural Resources Canada, the Department of Defense, on a lot more engagement on how do we build the sector. And you may not see it day to day, but we are behind those scenes. I presented to NATO on behalf of the Canadian government back in the fall when a lot of these new initiatives start. All the major mining companies are providing their own input. We're seeing, Agnico Eagle change its nature. It's Canada's largest company by, in mining period. Yeah. Although it's a major gold producer, but it opened a critical mineral unit, Avenir Minerals unit, back in the fall. So this is showing that companies are willing to lead and change. So it's all parts of the supply chain, majors, project developers, but we're also, if you look at the investment flow, it is coming across all sectors, gold, base metals, and critical minerals. We are seeing that benefit in Canada.
David, thank you very much indeed.
Great.
David Ononachuk of SGS, back to you live from PDAC.
Okay, thanks, Andy, for that. That's BNN Bloomberg's Andy Bell. We'll check in with him later. Coming up, Paramount Resources announced its fourth quarter earnings this morning, and we'll look at that amidst current geopolitical tensions right after the break. Stay with us. Paramount Resources shares are up this morning. The Canadian energy company reported an increased 2026 production guidance and expanded land positions. So let's bring in Jeremy McCrae, Managing Director of Energy Research at BMO Capital Markets, to break everything down. It's good to have you join us. Thanks so much.
Thank you.
So your thoughts on the production guidance, first of all, with this company?
Well, there was something in this quarter for everybody. So we saw the production guidance revised up by 2%, but not only that, we saw a 15% beat on the cash flow, 7% beat on production. There really was something here for everybody. And it goes back to what we're seeing from Paramount as they build up their new Duvernay position, have their facility, have better runtime, and it really just should give a lot of encouragement here for what we could expect for the rest of the year.
What are some other like key takeaways from the latest earnings report?
So the other thing that I think is encouraging here is when you look at their Duvernay results, this is where the big core of their production is coming from here right now. We're seeing these results come in actually even better than the type curve and what we were expecting. So not only do you get a better IP rate, but the wells are declining at a lot shallower rate, which basically means you can get that not only a quicker payout, but that 2 times payout, effectively where your profits are here. And so as we see more of these well results come into better runtime facility, it just means there's more, effectively production and cash flow that we should expect here for the rest of the year, also heading into 2027 and 2028 here. Basically, the subsurface is also working just as well as what we're seeing on the surface as well.
I wonder, though, with everything that's happening right now, with the conflict in the Middle East, everything that's happening in Iran, like how does Paramount Resources fit into kind of the broader sense of what's going on today?
There is a lot of volatility in the market here right now. They'll benefit from the higher oil prices and natural gas prices that we're seeing here. It's and I think it's difficult for anybody to have a perception of where these commodity prices may land here. But in the meantime, it is helping, have Paramount, realize a better commodity price. I think even before what we're seeing in Iran, there is a change in tone of what we were seeing with energy investors and more so generalist investors coming back into the sector. Investors seem like they're looking for hard assets, and despite where we were seeing with commodity cycle lows with oil, it was seen as a good position to start coming into the sector. So when Paramount has, just under $800 million in cash as well too, it is a bit of a defensive play. So when you add, some of the good production beats and encouraging signs for what we could see for the rest of the quarter, it's not surprising why the name is one of the better performing names here today.
When you add the uncertainty in, though, like obviously right now, as you say, oil prices surging, natural gas prices are up today too, particularly in Europe. But the uncertainty that we continue to see here, especially in terms of what's going to happen coming out of the Middle East, is that a headwind, do you think, for this company?
I wouldn't say necessarily a headwind. We're seeing a bigger movement here just in terms of how energy is seen in the global, portfolio here, where, when you look at it, the S&P 500, it only represents 3% of the index. So we're seeing more investors saying, just given the volatility, what we saw with Russia back a few years ago, now what we're seeing with Ukraine or with Iran, energy is a part of the portfolio that everyone should probably own in some way or in some weighting here. And it's just there are geopolitical events, and it's just a good reminder that energy is a good part and it should be a part of the portfolio. So that's the broader movement that we're seeing. I don't think anybody really wants to take a position on where exactly what we're going to see where the commodity price, but it is a reminder that commodity prices, likely could stay elevated here for at least, a few more months here, just given the uncertainty that we're still seeing.
For sure. Okay, so that's not a headwind, you would say. But are there any other headwinds really that this company is facing? Like this latest earnings report seems pretty rosy.
It is, and I think the only thing, if investors were to have a pushback here, is what we're seeing with natural gas. A lot of the natural gas that we're seeing here in Canada with AECO pricing still hasn't got the same benefit that we have seen in down in the U.S. and especially in Europe here. So as we start to see more LNG projects get approved and get built, that ultimately should improve things. But in the meantime, as we start to see still more natural gas come on by all producers here, AECO prices still remain, subdued.
Okay, so in terms of Paramount Resources as an overall investment today, how do you like it? Or is there other Canadian energy companies that you would prefer over this one?
We really like Paramount. Paramount is one of those names that just, quietly behind the scenes continues to grow and grow and grow. And if you look at the whole sector today, it's going to be one of the fastest growing companies looking to double their production here by the end of 2027, up nearly 2 times from where it is today. So for investors looking for growth and no debt, Paramount is that name that stands out. Outside of the Duvernay and the Montney, other names that we do like are in the Clearwater here, where you do see, some of the better rates of return, where a lot of companies are working on waterflood. And these are, names in the Clearwater like Tamarack and Headwater and Topaz are seeing the benefit of, waterflood, which is somewhat new to a lot of investors. So this is where we're seeing capital flow into those names here as well.
Okay, we'll leave it there. Jeremy McCrae, Managing Director of Energy Research at BMO Capital Markets. Appreciate your time. Thank you.
Thank you.
Coming up, our next guest, why Iran may be trying to exhaust U.S. air defenses and how that could leave the oil infrastructure for many oil-producing countries vulnerable. We'll dive into that right after the break. Our next guest says the Pentagon's arsenal of interceptor missiles might be running lower than the U.S. would actually like, and that could leave the region vulnerable to Iranian airstrikes. So for more, we got perspective from Mariam Mesmer of Chatham House.
This is going to be a big challenge. I mean, even for the United States, there are reports that after last year's war in June with Iran, that the arsenals for interceptor missiles might be running lower than the US would ideally like. And of course, the US wouldn't want to completely deplete them because it also takes longer to restock those arsenals. But we know that for the last several years, the US annually has purchased fewer missiles than it actually has been using. And so that means that at some point, probably in days rather than immediately, the US is going to face the challenge as for whether they are willing to continue with bombing Iran and trying to really take out all of Iran's military infrastructure, or whether they actually can't do that anymore. And what I have found really interesting about how Iran has been hitting back is that you can see that Iran has been trying to use older missiles and essentially has been trying to really drag out the targets that it selects in a way that would suggest that they are trying to exhaust US air defenses and those missile stocks.
Yes, and as of yesterday, the US said it had full air superiority, but, we'll see. What do we know about battles for the leadership in terms of the Iranian regime? Is there unification inside that regime? And when should we expect to hear about a new supreme leader?
That's a really good question. Given that the US and Israeli strategy so far has been to target anyone who could take up leadership positions in Iran, including opposition figures that actually were persecuted in Iran and that were not that well liked by the regime, it's I think it's going to be a very quiet announcement, if at all. So we've currently got the transition leadership in place, and I think because it's clear that whoever is going to be announced next as leader, or even if there's any other succession planning, that person is essentially going to have a target on their back. So I would expect that they either won't be announced immediately, or that if they are announced, they will only be announced if they are at a very secure location. And of course, one of the big challenges with the US plan to continue to bomb Iran is that Iran has a lot of very fortified military assets in the mountains. I mean, we might remember this from the US attacks last June, where they had to use these so-called bunker buster bombs to reach some of the nuclear sites that are buried deep underground or deep in the mountains. And so we can expect that Iranian leadership might be at similar bunker sites, essentially trying to hide this out as much as possible.
Very briefly, Marion, if you would, Israel has broken off a little bit. It's, involved in its own operations with proxies of Iran, essentially. And I'm curious, will the US have to engage with those proxies too at some point?
I think the US is very much trying not to. So what we've seen from the US is essentially trying to fight this entire war from the air and with some distance. And engaging those proxies would likely mean that the US would need to go where they are. So maybe go into Lebanon or go into Iraq. And the US will really not want to do that, because that would really go against this rhetoric that this isn't going to turn into one of those forever wars that President Trump's voters have essentially indicated that they really don't want the US to engage in. And it seems that Israel is very happy to essentially manage that challenge on the US's behalf. But what we can also say is, of course, that the situation in Iraq is becoming increasingly unstable. And so the longer this war goes on and the more different factions get drawn in, the harder it is going to be to manage this purely as a air campaign.
Okay, we're going to take a quick look at the markets before we wrap up here, because the TSX is falling sharply today, and we are continuing to watch that. That's where we'll start. It's down below 34,000 after reaching that new high last week. It's down more than 1,000 points today. And percentage standpoint, it's down by almost 4% at the moment. So obviously, investors a little bit wary about what's going on in the Middle East, and we're starting to see that reflected in both the TSX and the U.S. markets. If we take a look at some of the performers on the TSX, the worst sector is the material sector today. So gold is trending down at the moment. We'll take a look at the price of gold. The price of Aya Gold as one of the companies that are trading down. So Capstone Copper currently down more than 11%. New Gold is down almost 12% as well. And then Aya Gold and Silver also trading down at the moment by more than 11%. If we take a look at some of the biggest drags on the TSX, we're watching shares of Pet Value today. Of course, this company has reported earnings currently down by more than 14%. at the moment. We're continuing to watch that. Some analysts saying that pet value has a lot of competition on its hands right now, that it's having trouble stacking up to. So currently trading down at the moment. And we'll take a look at U.S. markets as well, because as I mentioned, investors a little wary today. The S&P 500 is down by 2.2%. Dow Jones down by 2.3%. NASDAQ also down by more than 2%, 2.5% at the moment. And then we're also watching, some of the factors that are coming out of this conflict between the U.S., Iran, and Israel. Oil is a big one today. We're continuing to watch the price of oil after Iran's Revolutionary Guard says that the Strait of Hormuz is now closed. So that's a big export avenue for many of the oil producers in the Middle East. Oil prices surging, so they're up more than 7% at the moment. We're also watching the price of natural gas today. It was surging earlier, but we're seeing a lot of volatility. So right now, natural gas prices up almost 5%, but particular volatility in Europe after Qatar halted production at the world's largest natural gas export facility after it was targeted in an Iranian drone strike. So we're starting to see some ups and downs in the natural gas as well as oil, but we'll keep watching all of that for you. That wraps up this edition of The Open. Morning Markets is up next with Roger Peterson.